Hi traders, in this video we're going to be taking a look at the double bottom candlestick pattern. This is a reversal pattern that you're going to look for in a downtrend and is going to signal potential for entering on the upcoming uptrend. So I have a euro dollar 1 hour chart here, and when you're looking for the double bottom candlestick pattern, what you need to do is find two levels of support, at least two levels of support following a downtrend. So here you can see we have a downtrend. Okay. And we have a level of support that's formed here. And in fact, this could be considered a triple bottom candlestick pattern, as it's hit 1, 2, 3 times this level of support. And it's certainly a triple bottom and double bottom candlestick pattern. Triple bottom because 3 times, double bottom because twice. So really with a double bottom candlestick pattern, just make sure that the support level has been tested twice, at least twice, as it has here. Price is beginning to move away and head upwards. Okay, so once you've marked the support level following on from the downtrend, the next thing to do is to mark the neckline. So the neckline is basically the resistance level within the double bottom candlestick pattern formation. So we have the double bottom here, so we're going to mark support. Okay, you can either use wicks or bodies. We'll use wicks. So the resistance is there within this double bottom candlestick pattern, triple bottom if you like, and you're going to wait for price to reverse away from the support level and break out through resistance. As you can see, this was a textbook play of the double bottom candlestick pattern. Price did approach the neckline and did break out. You can be comforted with extra confirmation of the neckline holding up from as tested here and here, which shows the strength of this resistance. I'm sure if you go down to the lower chart time frames, it will look more significant. However, I prefer to use longer chart time frames as they contain more data, thus the signals tend to be more reliable. That applies to candlestick patterns, price action, support, resistance, technical indicators, Fibonacci, pivot points, whatever you're using. Okay, so when price breaks out from here, you can look to enter. You can place a market order or a pending buy stop here. If you're going to be away from your charts, you can just place the order here. Be triggered. Some people may want to wait for a candle to close above this resistance level for confirmation, because there can be instances where there's a fake out. When it looks like price is breaking out, however, we'll turn back around, and that's what we have stop loss for if you do get caught on a fake out. And stop loss in terms of this trade would be, personally, I'd look to put it below the low of this candle or below support. Here would be just around 15 pips, which is a really tight stop loss for the 1 hour chart. And if you look at the move that we had following on from that, it would have given a really favorable risk to reward ratio, considering this trade went over 150 pips. Plenty of opportunity to make some nice profit on this trade. Okay, so that's the basic of the double bottom candlestick pattern. At least twice, you want support to be tested, and you want to draw the neckline and wait for a breakout of the neckline, the resistance level. For the stop loss, as price moves up, you might want to trail the price, perhaps take some profit, move your stop loss to break even, just to make sure that the winning trade doesn't turn into a losing trade. You can allow the remainder of the position to run, or just leave it all open. Just depends on your own money management strategy. Once price is up around here somewhere, what I would look to do is move the stop loss below recent support, just so we've locked in this. This is all locked in around 50 pips profit here. If price did turn around, we'd be taken out of the trade with a good amount of profit on the table. And you can do the same up here. Just try and maximize the potential of the move as much as possible. Other ways you can exit is you can just look at when price starts to consolidate for a long time. We're in a ranging market here. It may signal it's time to start looking to exit the trade. Yeah, so that's the basics of the entry on the breakout. There are the ways you can confirm your entries if you prefer to use technical indicators. I say prefer to use, but I think it's best to use together to combine price action, support and resistance, candlestick patterns, technical indicators. This indicator here is the ADX, average directional movement index. I've added a 20 level to it, as you can see here. Basically, with this indicator, you're looking for the green line to be above the red line, so the plus to be above the minus, which means that we're in an uptrend. Whereas if the red is above the green, as we can see here, we're in a downtrend. Okay, and I add the 20 level just because I find that if this blue line here on the ADX is above 20, it signifies that there's some momentum in the trend that the ADX is showing. Some traders might use a higher level, 25, 30. If you're range trading, you might wait for price to be, for the blue line of the ADX to be below 20 and then look to take reversals. As you can see within this channel here, it's ranging, the ADX is below 20. Some traders might have been looking to buy and sell on the support and resistance levels. Okay, but we're focusing on trend trading. The trend is your friend on this video. So our signal would have been confirmed by the ADX. Green above red, main line above 20, going in the upwards direction. Some nice divergence showing higher lows. All good signals that this breakout trade would have been a favorable one to take. Okay. The ADX can be good to consider exit as well. As you can see, when the red crossed above the green here, might have been a good time to take some profits. And it can also be used for entry. So if you missed out on this opportunity and you see in the trend moving and you want to get in on the action, you could have used the crossover here of the green above the red on the ADX. Main line above 20, showing that there's still some gas left in this particular move. You could have entered here. You have a nice area for your stop loss just below this support, which is only going to be around 15 pips again. So that would have been another entry opportunity. Perhaps if you did get in here and panicked and exited too early, would have a chance to re-enter. Obviously, this is an example when the trend continued. However, there will be times you would enter here and price would fall against you. We can't just cherry pick good trades, we have to be aware that not everything will be rosy all the time, and that's why you have a tight stop loss to, well, I like to cut losing trades short and let winning trades run. I mean, you wouldn't want to enter here and have a stop loss down here, would you? Because, you know, you take nearly 100 pip loss on a trade unnecessarily. Just makes it harder to turn a profit if your losses are that high. If you have a good risk to reward ratio with a tight stop loss of even 20 pips, let's just say you did enter here with a 20 pip stop loss, the price did go up over 100 pips, so at least a 5-to-1 risk to reward ratio. I mean, that's the ideal scenario, but even if you exited here, again, if you use the ADX, you see, okay, the ADX falls below 20, you have the red line goes above, suggests we're losing some steam. Still, you know, you have 40 to 50 pips profit potential, and that is getting in on the trade later. Otherwise, when price did get around here, instead of exiting, you could have just moved your stop loss to break even and just let the trade play out. Okay, so this is just one indicator example you can use for timing the entry on the double bottom candlestick pattern. Is basically just to find the start of the trend. Once the trend is established, there's numerous ways you can enter. Crossover of a stochastic oscillator here in the oversold zone would have been an entry point. Yeah, you can just use resistance. Here we can see resistance tested. So when price did break out here, have a nice uptrend and a breakout of resistance. Again, another entry opportunity. Candlestick patterns showing that perhaps the bears are starting to lose steam. Bulls are pushing the market up. Spinning tops, indecision, you have some hammers. Yeah, inverted hammers here. Plenty of ways you can identify trades. Most important thing is to have sensible money management. You can use indicators for confirmation of entry and exit, or just to confirm the trend direction and momentum, and avoid taking trades where some indicators don't agree, because they can keep you out of trouble. But yeah, this can be, you can look for this double bottom candlestick pattern or triple bottom candlestick pattern. I do have a video for that as well on any trading instrument and time frame, but the longer term time frames tend to be more reliable from my experience. Also means less time watching the charts, which is great. Okay, thank you for watching. Hopefully you found something useful in this video. Please like and subscribe for more.